Hello and welcome to House of Commerce. Hope you all are doing well. So in today's lecture, we are going to discuss about depreciation, the 5 methods of recording the depreciation, the complete accounting treatment till the end. So watch the video so that you may come to know about what is depreciation and what to do in accounting. So firstly, we are going to discuss about the definition, and that is decline in the value of fixed assets due to wear and tear. Due to wear and tear, except land, because land does not lose its value. I'm not talking about property prices decline. I am talking about the wear and tear, decline in the value of fixed assets due to wear and tear. Therefore, the land does not get wear and tear according to its nature. That is why it does not get depreciated. Although other assets gets depreciated, but not because of any damage or any loss or any fire or something, but due to wear and tear. Means if the assets lose its value according to its nature, means if asset is made up of steel or if the furniture is made up of any wood, so both the assets will lose their value according to their nature. So that in that case, we will say that the asset has got depreciated. Now, moving forward to the 5 methods to record depreciation, let us go. Okay, so there are 5 methods to record depreciation, and it is up to the company that what method does it adopt. So, number 1 is a straight line method, number 2 is diminishing balance method, number 3 is working out method, number 4 is unit production method, and number 5 is sum of the year digit method. Do remember one thing, that we will discuss these 3 in this video and the rest 2 in the next part. So let us discuss about the straight line method in detail, about the formula and one practice question as well. Okay, so number 1 is straight line method, and the formula to record straight line method is cost minus salvage value and divided by total useful life in year. Now here, it is important to discuss that what is salvage value. Salvage value means the value which is left over after the end of total useful life of the asset. The other name of salvage value is scrap value as well. Means if I have a machinery and it has a life of 5 years, then after 5 years, it does not mean that machinery will get its value to 0, but it would have some of the value to be sold in the scrap. So that is salvage value, and I am deducting that salvage value from the cost because it is to be left over at the end of total useful life. Therefore, I will deduct it at the start, and then the remaining value shall be divided by the total useful life in year, and then I will get 1 year's depreciation under straight line method. Okay, so here we have a question. Cost is 100,000, then salvage value is 10,000, and the total useful life in years is 5. Now, another question we have, depreciable cost. Now, what is depreciable cost? This means the cost which is to be depreciated throughout the whole useful life of an asset. Now, how to get depreciable cost is cost minus salvage value. So if we deduct salvage value from the cost, we will get the depreciable cost, which is 90,000. Then we are able to solve it, and we are able to get depreciation from this. In year 1, cost minus salvage value, which we already have, and divided by the total useful life 5. We have got 18,000 in first year. Then year 2, 90,000 divided by 5, we have 18,000 again. Then in year 3, year 4 and 5. Now if you have a question in multiple choice questions or something, which depreciation method has same consistent depreciation every year, so that is a straight line method. So hope you have got idea about this. Now let us move towards diminishing balance method. Then the second one, diminishing balance method. Now here we have a formula book value into rate. So whatever the book value of an asset is, by multiplying with the rate, we will get the depreciation for a year. Now, the question arises that what is book value? So book value means cost minus total or accumulated depreciation till the year I am standing. So if I am standing at the end of the second year, so by deducting the total depreciation till second year from the cost, I will get the book value of the same year. And by multiplying that with the rate, I will get the depreciation for the next year. Now let's move forward to an example of this. Okay, so here we have a question. Cost 1 lakh, salvage value or scrap value 10,000, and the rate of depreciation is 10%. So here we don't have to do anything with salvage value. We have the formula book value multiplied by rate. So let us see. Do remember one thing, that depreciation is calculated at the end of the year. So here on year 1, we have 0 depreciation because it is going to end. It is not ended yet. Therefore, we are going to have the depreciation for the first time. That is why we will deduct 0 depreciation and then multiply by 10%. So here we have 10,000 for the year. Then we have the total depreciation at 10,000 as well. Then year 2. Now here we have 1 lakh, the same cost, and 10,000 the total depreciation. Then multiply by 10% and we have got 9,000 as our depreciation expense for the year. And the total depreciation, by adding the previous one and the new one, we have 19,000. Now 1 lakh minus the total depreciation, 19,000 multiplied by 10%, we have 8,100 depreciation for the year, and the total depreciation 27,100. Then 100,000 minus 27,100 in year 4, the total depreciation at the end of year 3, multiplied by 10%, and we have the depreciation expense for the year 77,290. And here we have the total depreciation. So in every next year, you have to take the depreciation, total depreciation of the last year. So you will get the book value, and by multiplying that with the rate, you will get the depreciation expense for the year. Now that was all for diminishing balance method. Okay, let's move to the third one, working hour method. And we have got the formula cost minus seller's value and divided by total useful life in hours. So here we have a question. Cost 100,000, salvage value 10,000, and life in hours 9,000. Then all you have to do is, firstly, you got to take out per hour depreciation. And how to take out that? First cost, then minus salvage value or scrap value and divided by the total useful life in hours. And we have got 10 rupees per hour depreciation. Now we have the following data in the question, that first year we consumed or we used the machine for 2,500 hours, and second year we used the machine for 3,000 hours, and then in the third year we used the machine for 2,700 hours. Now by multiplying each and every hours along with the per hour depreciation, we will get per year depreciation. In year 1, the machine was used for 2,500 hours, and by multiplying it with 10, we got 25,000 per year depreciation. Then on second year, 3,000 into 10, 30,000. And then in year 3, 2,700 into 10, and we have got 27,000 per year depreciation. So that was all for today's video, and we shall discuss the 2 more methods of depreciation in the next video. Till then, good luck.